The Russell is back, outperforming the S&P 500 by a very large margin today. Heading into earnings today and after hours from your mega cap names, this is important because right at about the time you guys are watching this video, Tesla and Alphabet, better known as Google, will be reporting earnings, and these companies combined are worth well over $3 trillion. That is more market cap than the entire Russell 2000 put together. You also have earnings from Enphase, Visa, Texas Instruments, Chubb's, Seagate, Capital One, Kane Foods, and PCA. These first big tech stocks that are reporting earnings are really going to set the tone for the markets going ahead over at least the next couple of days. We do have some data coming out later this week that I will go over and why that will be important. You do also have some data coming out tomorrow morning. Fueling part of this outperformance on the part of the Russell 2000 today are 10-year treasury yields that are down about 3 basis points, back down to 4.22%. The Russell 2000 is up over 1% at the time of recording this video, and the S&P 500 is only up 0.2%. So this is a 500% or 5x outperformance of the Russell today. Also, some weird political headlines hitting the news wires today, including this one, that apparently President Biden suffered an undisclosed medical emergency during his time in Las Vegas, according to police sources. This is shared on X by Bill Ackman and has been recirculated many other places. And I think overall, the political volatility, we haven't even seen the start of it. I do think that is still a potential risk factor for our markets. Right now, Wall Street is firmly in earnings mode. Earnings need to come through to support the valuations that we are currently at. And I am a little bit concerned because I think your GPU providers are going to do just fine, but the enablers of AI, or the scalers of AI, I should say, Google for that matter, that reports earnings today and after hours, I don't think they're going to have much of any kind of return on their AI investments. And that's something the markets might start to punish. Now let's start off this video with this. This is Bank of America's Savita Subramanian on why we are heading into a tricky, quote, part of the year.
BofA's Securities Head of U.S. Equity and Quantitative Strategy, Savita Subramanian, joins us. S&P target of 5,400. Savita, always a treat for us. Good to see you.
Great to see you as well. Thanks for having me.
I was just looking back. It's been a little over a month since you did say you had conviction in the S&P, but your enthusiasm had waned based on some of this swirling around of bearish sentiment. Has anything changed?
Well, I think that, if I had to call a market direction from here, it's higher. But I think in the near term, there are a lot of reasons to maybe pare back exposure, especially to big cap tech, and think about where you want to really pick your spots. And that's why my conviction in the index level itself is, not as high. We're not as bullish as we were at the beginning of the year because a lot of other bears have capitulated. And we've also seen the market move significantly higher, led by, again, a narrow cohort. So I think from here it broadens out. But what worries me is that if big cap tech doesn't hold up from here, we might not see as strong of gains in the overall benchmark. We're also heading into a tricky part of the year. So not only are trends seasonally weaker as you move into the summer, but we also have this election coming up in November. And what we found is that the VIX generally jumps by about 25% from June or end of June to November of election years. And this election is even more kind of uncertain than prior elections have felt.
Interesting. When it comes to the AI names, and we will get Alphabet tonight, for example, there's been a lot of chatter this week about estimates for AI capex among the hyperscalers rising faster this year than estimates for sales. And are you suggesting that the street might run out of patience for these investments to pay off?
Exactly. That's exactly right. So the idea here is show me the money, show me the fruition and the monetization of AI. And where we are now is an environment where folks are spending and the hyperscalers are spending, so they're cutting into their free cash flow generation whereas last year they were in bunker mode. They weren't spending on capex, and then you had this huge surprise of, AI, generative AI, and strength in that cohort. This year, the surprises are we think, baked into the companies, and they're spending more of their free cash flow. So it's a less kind of compelling story from here. Still strong, and we still admit that growth is in tech, and that's not going away, but expectations have really risen to where these companies are today. So our view is that there's probably more upside elsewhere in the market, which is why we like old school capex, and we don't think that's getting a lot of attention. The growth isn't necessarily priced in those cohorts, but I do see a strong infrastructure spending cycle coming up that's almost mandatory rather than nice to do. So that's where we really see the strength in the market.
What is old school capex?
Old school capex.
What is that? Who benefits from that?
Exactly. What am I talking about? So old school capex is basically industrials, materials, even energy, oil, and it's the idea that in order to power up all these chips and also to support all of the extra activity that has been moved from overseas back to North America, we need better roads, highways, dams, etc. And what we're seeing in the engineering data is that the U.S. isn't doing great on infrastructure. We've spent the last 10 plus years underinvesting in manufacturing and infrastructure in the U.S., and now we've just swapped about double the activity on U.S. soil. So it's all coming to a head. It's not only the chips, but it's also reshoring and nearshoring. It's, this North America corridor of busyness, on top of which we haven't really spent on a good old-fashioned refurbishment cycle in, over a decade. So I think that's where we're going to see some stronger gains, some more money spent. And when you look at industrials, when you look at these traditional old school capex plays, they're not necessarily pricing in as much good news as AI and chips and, mega cap tech.
Which, I think that was powerful because, one, Bank of America did not have one red trading day in the first half of 2024. They were the only investment bank to not have a single red day in the first half of 2024, which is pretty unprecedented to go half of a trading year, around 130 days or so, with no red days. But also she reiterated what I've said for quite a while now, at least for the past month or so, that a lot of the gains in your mega cap stocks are already pricing in really good news. Like, you're gonna have to, as I've said before here on this channel, have a knock your socks off kind of earnings from these mega cap names to really get any substantial further upside. Could they go up 2, 3, 5%? Of course. 10+% starts to look a little out of reach. Let's just be honest. And the investment thesis for these names is strong in the long term, but are markets looking at the long term? No. Markets are saying, hey, what's the return on investment going to be for this AI investment this quarter? What about next quarter? What about next year? When really these themes are 5, 10, 15, 20-year long theses. And we're not even thinking in the next 2 years. We're thinking in the next 2 quarters. And that's where potentially you could be set up for that larger rotation. And one reason why I think Tom Lee is 100% correct in this small cap summer theory or thesis that he has. If you guys watched the video that came out last night, Tom Lee is calling for about a 40% rally from here in the Russell 2000 by the end of this year. Some of that could be fueled by the economic data that, as Tom Lee says later this week, will really start to boost the odds of not only a September rate cut, but potentially a July rate cut, because inflation is, he thinks, going to come in really, really low. And I will tell you right now, you have to agree with Tom Lee. The EPS growth rates are going to outperform or outgrow the S&P over the next 2 years, minus any exogenous event that happens in the economy. You are seeing still very low valuations for the Russell 2000, and a good chunk of the Russell 2000 is profitable. Now, the parts that are not profitable will be helped by rates falling. When rates get cut, the odds of a recession falls. What's there not to like in the Russell 2000? Well, I'll put it to you as simply as possible. If we go into a recession, if more recession fears start to build, that's what you would not, I should say, that's where you would not want to be invested heavily, is in the Russell 2000. But with the soft landing narrative right now still intact in our markets, clearly evident by valuations across the board, especially in your mega cap tech names, there's no pricing in of a recession. If there's no pricing in of a recession, small caps will do well and will outperform the S&P from this point going on. In my personal opinion, again, I'm not a financial advisor, so come to your own conclusion. A really long story short, unless you have some kind of recession call in your forecast, I think it's almost impossible to be bearish on the Russell 2000. Impossible is an imperative term or subjective term. I think for the average reasonable investor, it would be impossible to be bearish on the Russell 2000 unless we're going into a recession. Maybe that's the better way to put it. Now, later on throughout this week, including tomorrow morning, you have Vertiv that reports earnings. That's going to be a very interesting one. That stock is up a lot, really connected to that AI trade. AT&T, Lamb Weston, Next Era Energy, Thermo Fisher Scientific, GE Vernova, General Dynamics, and Boston Scientific. Tomorrow and after hours, you have Chipotle, Ford, ServiceNow, IBM, Viking, Las Vegas Sands, Newmont, Whirlpool, and Waste Management. Thursday pre-market, American Airlines, AbbVie, Hasbro, Honeywell, RTX, Southwest, Keurig Dr. Pepper, AstraZeneca, and Valero. Thursday and after hours, Dexcom, Skechers, Texas Roadhouse, Deckers Brands, Boston Beer, Juniper, Lending Tree, and a couple of others. And then Friday pre-market, you have Bristol Myers, 3M, Charter, Centene, Colgate, and T. Rowe Price. Now, today we did have existing home sales for the month of June. They came in at 3.89 million. We were expecting around 4.25 million, so housing market slower than we thought. Existing home sales month over month, negative 5.4%. We were expecting positive 3%, so some pretty big downside surprises for your pending home sales data this morning. Although markets didn't care about that too much, I do think it is notable. Richmond Fed Manufacturing Index came in at negative 17. We were expecting negative 8. Richmond Fed Manufacturing Shipments came in at negative 21. We were expecting negative 7. And Richmond Fed Services Index came in at positive 5. We were expecting negative 9. So really bad manufacturing data again out of the Richmond area, and the services came in a little bit hotter than we thought. Still not a great number at 5, but better than negative 9. And we were expecting the services would actually be the worst part of today's data. So that was kind of a mixed bag. Now, coming tomorrow, we will have the goods trades balance, retail inventories excluding autos, and wholesale inventories month over month, advanced data, all of this for June. So the first estimates, and this will move the Atlanta Fed GDP Now estimate for Q2 GDP as well. Going to get the next update coming tomorrow morning. We're currently setting up for a 2.7% GDP number for Q2, although that's going to change a bit before we get the actual number coming out. Tomorrow morning, you will get the Bank of Canada interest rate decision. We are expecting they are going to cut rates by 25 basis points from 4.75% down to 4.5%, but we'll have to see. You will get S&P Global Composite PMIs, S&P Global Manufacturing PMI, and S&P Global Services PMI, expecting these numbers to tick down marginally, but not expecting any big shock or downside move. If that happens, then I think markets will get maybe a little bit more fearful about global economic activity. Although this is for the US, it does incorporate some of your global stuff as well. So that data comes out tomorrow, as well as a speech from Fed Bowman at 4:05 p.m. So right as the markets are closing. On Thursday, you will get your GDP growth rate quarter over quarter advanced estimates for Q2. Again, expecting around 2.7% GDP, but the data coming out tomorrow will heavily influence that number, and you could see a large tweak to those estimates. And then durable goods orders month over month will also come out on Thursday, expecting positive 0.4%. Last month, you were positive 0.1%. So expecting some pretty good numbers for durable goods orders. And then Friday's your big data with core PCE month over month, expecting 0.1%. Last month, you were at 0.1% as well. So not expecting much of a change there. Personal income month over month expected to actually fall a little bit from last month, 0.5% down to 0.4%. And personal spending is expected to tick upwards from 0.2% to 0.3% month over month. So quite a bit of economic data coming out over the next 48 hours or so. But I will say the reason I think or almost know at this point the political volatility is not affecting the markets because we're just, heading into earnings season. We still need to know what the earnings are. Earnings are always going to be the most important catalyst. It's like sitting here saying, what's more important? Your, let's say, personal spending data or CPI data. Well, personal spending's very important. If it plummets, that's not great for the economy. Obviously bad news. But what's more important? CPI is more important. That's kind of like what we have going on now. What's more important, earnings or the political uncertainty, the political volatility? Obviously earnings in the near term, but the political uncertainty will come back and it will have a negative impact on our markets at some point. Now we are going to get the official resignation speech, presumably from Joe Biden, coming tomorrow around 8 p.m. At least that was announced today. We'll see if the rumors of some kind of medical episode or event are actually true or not. I don't think that'll affect the markets too much, but it's a possibility. Here today, CNN's fear and greed indicator is in greed territory at 58, which is higher than where you were yesterday, which is kind of surprising. I guess not as surprising. The Russell's outperforming so much today, and this outperformance of so many other stocks is kind of boosting these numbers a bit, but nonetheless, you're at 58. Yesterday, you were at 55, which was neutral. So if we do go through a downside reaction in markets, potentially based on earnings, again, that are going to be coming out right at about the time this video is posted, I'm not very optimistic if you want my honest opinion here. Could I be wrong? Of course. But there could still be quite a bit of room to fall if we're judging off the CNN fear and greed indicator. Market momentum, extreme greed, stock price strength is now neutral. You've been in fear territory or extreme fear territory for quite a long time now, so that's now neutral. Stock price breadth is fear, although that's getting better. Put and call options, extreme greed, and market volatility is neutral. Safe haven demand is fear, and junk bond demand is extreme greed. The percent of stocks currently trading above their 50-day moving average is actually up almost 1% today. So almost 1% of all stocks are breaking above their 50-day moving average today. That's actually pretty good, again, relative to the performance of the S&P 500 today. And now you're sitting at 69.5% of stocks currently above their 50-day moving average. And again, this shows that you have seen quite a breadth thrust in the last couple of weeks. I think this could continue, especially if we see the Russell really continue to outperform. But also this could fuel more downside as now more stocks are in uptrends. The Fed rate monitor tool is pricing in only a 3.1% probability of a cut coming July 31st, a 96.9% chance of no cut by July. If Tom Lee is correct, the data this Friday could raise those odds at least a bit, potentially up to 25 or 25%. We'll have to see. For September 18th, you're firmly pricing in your first Fed rate cut, 91.3% odds of a cut, at least one by September 18th. There's also 2.9% odds of two cuts by September. So overall, there's almost a 94% chance, a little bit over 94% chance of at least one cut by September. November pricing in two cuts at 53.9% odds. And by December, you're pricing in three cuts, 48.3% odds, and 43.2% odds for only two cuts by December. 10 and 2-year yield curve inversion is slowly uninverting. Now you're only inverted 24 basis points. You were inverted last time I shared this with you guys, 26 basis points, so slowly uninverting. Now, history would suggest is when you uninvert, you see the pain in markets. That's normally because you're heading into a recession by the time you're uninverting, and that happens because that's usually when the Fed starts cutting rates, when you start to uninvert. I would be careful drawing historical precedents from this, because just because the Fed is going to start cutting rates soon, and that's the reason why we're uninverting, doesn't necessarily mean you have to see a recession soon, or it doesn't necessarily mean that there needs to be big downside for markets. Although historically, when the Fed cuts rates, you do tend to see the S&P fall over 20%. Fundstrat's Tom Lee wrote this, quote, "In bull markets, when Russell outperforms SPX by 8% or greater over a 10-day period, which is rare, every single time the Russell is higher 1 and 3 months forward to the tune of 5% and 8% respectively, it's a bull market." By the way, Liz Ann Saunders, that is the chief investment strategist at Charles Schwab, writes on X, "Quite a shift in excess savings dynamics over the past couple of years. In the past couple of quarters, the amount of money turned negative for all income cohorts per Moody's." You did have UPS that came out today with not so great earnings, as Sven Hendrick says, the first earnings bomb this quarter. This was the worst earnings you have seen, or worst reaction from earnings you have seen from UPS since 2008, if I read that news correctly earlier. And I mean, it's just not a good look when UPS has bad earnings. That's seen as kind of one of those bellwether companies. Adjusted EPS came in at $1.79 versus $1.98, which was the estimate. Revenue at $21.8 billion, estimate $22.37 billion, and UPS sees full year revenue at $93 billion. UPS restarts their share buyback program and targets $1 billion annually, and UPS was down over 10% today on this report. The Fed is set to cut rates by 50 basis points in 2024, say 73 of 100 economists. 13 only say 25 basis points, and 3 say no cuts at all. Now, this is a new clip from BitDeer and Tom Lee, that's who put this on, explaining what S&P earnings could look like for the rest of this year.
And there were people that said the S&P wasn't even going to make $60 again for a decade. That's why in the GFC, everyone said expect a decade of low returns. And I saw countless models. People said, well, inflation's going to be weak and GDP, and so it'll take forever to get to $60 in earnings again. Well, the S&P 3 years later had $90 in earnings. And, you know, and now earnings are expected to be $280. Okay. So we've gone from $60 to $280 in 14 years. Why do people suddenly think earnings are going to peak at $280? I mean, S&P earnings, you know, is going to be over $1,000 per share in the near future. And I know it sounds incredible, but one of the things driving this, and we've written about it for our clients since 2018, is that the world is running out of prime age workers. So we have population growth, but it's growing faster than the number of people that actually can work. That difference in population means instead of paying wages, you have to pay a company to produce a machine for output. Okay, so that money is recycled into the S&P. By the end of this decade, it's almost $4 trillion a year in wages that are no longer paid to people, but to another company. If it's AI related, that could mean NVIDIA's revenue could be $1 trillion by the end of the decade. And NVIDIA's revenues are $100 billion right now. So NVIDIA itself could be a 10x. I mean, I think people are unimaginative when they don't realize they're not looking back far enough. In 2008, people didn't think S&P earnings would get back to $60 for a decade. So that's 2018. They didn't think we'd be back at $60.
I mean, that's just absolutely incredible. Tom Lee says in the not so distant future, the S&P 500's EPS will be $1,000 for any given year. Let me put it to you like this. If the S&P 500 earnings were $1,000 this year, with the current multiples we're trading at, the S&P 500 would be at almost $22,000. That's just mind-blowing. Now, this is obviously the longer-term perspective. We're not going to get there next year, the year after that, or the year after that. But 5 years, 10 years from now, depending how things go, as long as the economy does not go through any hard reset or big recession, yeah, it's hard to be bearish with those kind of numbers. But again, the bar is already pretty high. You can see here from Goldman Sachs Investment Global Research that they're expecting, well, Wall Street generally on average is expecting about 14% S&P 500 EPS growth next year. Goldman Sachs top-down estimate is for about 6%. So you have high expectations for next year's earnings. And really, that's what it's about right now. As you are in late July, almost in August, Wall Street's paying attention to next year. What can we extrapolate from earnings now for the future is essentially what this earnings season and next earnings season is all about. And any kind of disappointment here, especially from your companies that put up the highest amount of EPS, like your Super 6 or Mag 7 for that matter, that's what is really going to drive the markets. And I think that's why today's earnings with Google specifically, also Tesla to a lesser extent, are very important for the headline S&P 500. At least in the near term. Goldman Sachs also says today the rise in the unemployment rate looks unusually benign and we see recession risk is low. With immigration now slowing, we think the U.S. economy will only need to create 150,000 jobs a month going forward to keep the unemployment rate stable for the rest of the year. And as I have stated recently, I think your important levels to watch for on the downside for the S&P are really just your moving averages. Your 50-day moving average at about $540 on the SPY, I think that's going to be a strong level of support. If you break under that, your 100-day moving average at $525 is going to be a big level of support. I also have this line drawn here at 520. I think an even round number makes sense there. That's where you did find a lot of support as well back around May 30th and May 31st, as well as on July 3rd, that next following Monday, and then you were kind of off to the races from there. If you did get under all of those levels, the big level I think you'd see a lot of money start to flow back into markets would be this 200-day moving average at about 492. Now, as we go each and every single day, this is going to move up about 25-30 cents or so each day. So as we go throughout the days, this gets higher, but I think that 200-day moving average would be a good level to hit. That would be a very healthy correction. I think people would start to, reallocate capital back into basically everywhere in our markets at that point if you did see a reset to that magnitude, although I don't think that's going to happen. I think the 100-day moving average is probably a better, more base case scenario at this point. That's about 525. That would put the top to potential bottom correction at about 7%. Although you normally see about 13% corrections during election years, I think people just want to be bullish. I think people are hanging on to reasons to be bullish. We don't really want to price in much risk right now. So as long as things do not get super bad, as long as earnings are not terrible from your Super 6 companies or your Mag 7 companies, I still think people want to be bullish right now. And that's powerful when momentum is in the upwards direction, much the same way as it's powerful to the downside as well. So let me know what you think about all of this information down below in the comments section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.